Good evening, everyone. My name is Kordell Stevens. I'm hosting the live tonight for 7X Investors. I'm going to just give a little synopsis about myself. I've been trading for almost 20 years now, 19 years. And come next year will be my 20th anniversary. Most of that time I have spent in trading CFDs and currencies. So Forex, for those of you who know it by name, and have recently done some futures trading. I have in the past been a day trader and then switched to a longer term trader and then investor, and now back to day trading. So I did day trading from about 2008 to 2011. And then took a break and went into more longer term trading around 2014 and switched to investing in 2016 because I saw a move in the dollar that was taking place, and I held that move for almost 2 years. And so I would consider myself an investor. What do I like about trading? I like the macroeconomic side of trading, really enjoyed that. What that brings to us is an opportunity to look ahead, plan, and get into larger moves. But the macroeconomic environment has changed. And so now it's almost trading is day to day and changes in trading. So a little bit different environment. So I still love the macro side of trading, but right now, currently, I am day trading day by day. With that, still that large outlook, but still very cautious, and can't put a lot of faith in a long-term outlook these days. Very uncertain. We have seen that just recently, the amount of geopolitical events that have been taking place, it makes it very hard to know what black swan event or watershed moment is going to change everything in the market. So far, the markets have been pretty resilient to the things that have been happening. I would contribute some of that to COVID and what we went through with COVID, and how the markets bounced back from that. A lot of that had to do with stimulus, which we are now feeling the effects of with increased pricing. But I think the markets are a little bit more resilient. But what we are going to talk about tonight is something that a lot of traders don't know too much about. Some do, some don't. Depends on what space you're trading in. But it's something that all traders should learn and know, at least the basics of it. And that's what I'm going to give tonight, is a very basic outline of the bond market and yield curve. Now, when you hear those two things, bond market and yield curve, you're going, ugh, man, how boring is that? Well, I'm going to try to make it not too boring for you. And it's an inverse relationship when you talk about bonds. So it may get a little confusing, but we're going to try to keep it real basic, real simple, and give you what you need to have to trade in the markets. So that's what I'm going to give you tonight. And that's what we're going to learn, is this relationship with the bond market or bonds to trading something like Forex or futures or stocks. We're going to learn how the bond market is really, it's like the foundation. It's like the pivotal market to understand to go forward in trading securities, okay? Most of you have heard of late a lot about rates rising, okay? Now, you see here on my screen, I have the US 10-year Treasury note, okay? And why we look at that a lot is because that gives us kind of the middle of the road. It's what a lot of things are based off of. That's as far as I'm going to go with it. But it's what a lot of things are based off of when we're looking at rates going higher or lower. And you can see here that rates are definitely currently going higher, almost to 5% on the 10-year. Now, how do we look at the rate of the bond, or in this case, the note, and the price of the note? Those are two inverse relation. That's an inverse relationship. So when yield goes up, the price of the note or bond, we're just going to call it bond, goes down. When yield goes up, price goes down. Now, the way you make sense of that is if something isn't in demand, then you're going to offer a sweeter deal for it to get it off the shelf so people will buy it in this case. So in this case, hey, look, I know you're not real interested in buying these bonds right now, so we're going to increase the yield on them, okay? We're going to make this really attractive, so you'll come in and you'll buy our bonds, okay? And that's really kind of what's happening now. We're seeing a shift in equities because what you can make in bonds now is kind of almost outperforming what you can make in equities or stocks. And stocks are a high yield, high risk investment, whereas bonds are well, in this case, getting a higher yield and lower risk. So as an investor, why wouldn't you want to shift some of your portfolio over to bonds? And that just makes sense. So we're seeing that now because the yield is becoming so high on these, and the price of the bond is becoming very cheap to buy. And so investors are looking at this yield because investing and trading is all about yield, where I can go to get that yield. They're looking at this and they're going, I think I want to buy some treasury notes, or I want to buy some bonds, okay? And also, I'm looking at all these geopolitical events and things aren't looking too good. Things are looking like, well, there's a lot of uncertainty. So I want to divert some of the risk I have in stocks into bonds. And that's called risk off. So we go from risky assets into more secure assets like fixed income, like the bond or the treasury note. And so that's kind of what's happening in the market right now. Now, a lot of that has to do with the Fed, and I'm not really going to get into that, but this shift is beginning to happen for that reason, because the yield is looking very good in the bonds. And security and yield, boy, if you got that, that's where you want to go. So with that being said, we're going to, now, the first part I want you to understand is that why the market is shifting from assets, high risk assets to low risk assets is because of the yield. And second, that relationship between yield and price. Remember, as yield goes up, price goes down, so that the Treasury can make it more attractive for investors to buy their debt, the government's debt. So that's what's going on here. The yield sometimes also goes up because the asset, or in this case, the bond, maybe it's a country, not so much with the US right now, but it could get that way. But say a country's debt they're looking at having a hard time paying their debt, the bond becomes more risky. So they make it more attractive by raising the rate on the bond. That's another reason why the rates might raise on a bond. So with that being said, we're going to look at how we're just going to take the 10-year, for instance, how the 10-year rate raising up could have a drag on assets. So what we're going to do here is we're going to add the S&P onto this chart, or we'll just do it, yes, since it's available here. And you see that there is becoming an inverse relationship now with the S&P and the yield on the 10-year. You see that the S&P is starting to move down, and the 10-year, as the 10-year moves up. So you see that they're separating here, kind of like in ET, where the boy and the alien begin to separate their heartbeats. It's beginning to separate here. And whereas we used to have a relationship where, if we go back here, yield's been going up for a long, we're going to have to reduce this down to a weekly chart, or expand it to a weekly chart so we can see it a little better. So you can see how when yields would go down here, let me just grab a pin here so I can mark that, how yields, when they were going down, stocks were going up. Now, there is a lot of reasons for that, and I don't want to get into this because it gets too detailed. There's a lot of reasons why that's happening, okay? But just so you understand it, that is why, let me grab my pin here and bring it down so I can have it. That is the relationship right now between stocks. So it stands to reason that if the yields are going up, stocks should be starting to go down. And we're seeing that. We're starting to see that relationship of the yield going up, stocks starting to go down. And I mentioned why that is. Investors going into stocks, the yield's better. Okay, simple right now. Now, how can that's one of the ways yields going up can determine how we invest in, say, stocks or equities. Say like we're trading a CFD in the NASDAQ and or in the S&P, we're going to want to look, if yields are going up that day, we're going to want to look for opportunities to go short in the market. So if we see a move going up, we want to look for that opportunity to go short the market. And that's how we use this relationship here between equities and the yield on the 10-year. That's how we use that relationship to be able to come in and trade, okay? The next thing that we want to look at is maybe how does the yield or the yield curve help us to understand possibly what's going to happen in the future and how we can prepare for that. Now, this is more of the investment side of trading. However, it does have a direct effect on our weekly or daily trading, because if we begin to go into a recession, markets are going to correct. And there is going to be a large risk-off movement in markets, meaning people coming out of equities and people buying bonds are a safe asset, okay? And so that means as people come out of equities, they're going to be selling them. That means things like the S&P and the NASDAQ and the Russell 2000, those are all going to be heading down, both large and small caps. Small caps will happen first, then follows large caps, okay? So with that being said, let's look at the yield curve. I'm going to pull this down here. We're going to blow this up and look at the yield curve. Okay, so right now we have what's called an inverse yield curve, okay? An inverse yield curve. Now, an inverse yield curve means a curve that looks like this, okay? That's an inverse yield curve. And you see over the months, this is 6 months, and this is 3 months, and this is 1 month, okay? Now you can see it's starting to change. So this front end, we call this right here, the front end of the yield curve, and we call this over here the back end of the yield curve, okay? And this is in the middle here, okay? We see that this inverse is starting to level out. And we spoke for some of the reasons of that happening. But this is what we call a negative yield curve. When the yield curve, right here, this is a negative yield curve. We're just going to put negative right there. Negative yield curve. That's what that is, okay? Now, a good yield curve, so if we have a curve like this, what do you think a good yield curve? Well, a good yield curve is like this, okay? It's a positive yield curve. And that means that, you know, we have possibly some inflation, so forth. Negative means deflation. Negative means recession, things like this. Positive means inflation. Positive means productivity, good GDP, all those kinds of things. That's going to be somewhere in the future, but right now we're going to talk about the negative. So what we're going to look at is the difference between the front end of the yield curve, and we'll just call it the 2-year note against the 10-year note. And we're going to look at a chart that measures that. So it's the difference between here and here, okay? And you see there's quite a difference between those two right there. It's negative, meaning the 2-year is actually higher than the 10-year. Now we're going to be looking at to see if the 10-year actually becomes higher than the 2-year. But this is very important to understand this inverse relationship, because now we're going to look at another chart. This next chart, let me bring this down here, is very important because you're going to see something here. This is what's called the 10-year Treasury constant maturity minus 2-year Treasury constant maturity. And what this shows you is the negative yield curves. Now, why is this important? Well, because before we have a recession, these lines right here mark recessions, okay? The pink lines mark recessions. Before we generally have a recession, and here's some more, go back, way back, but we're just going to come up here to the 90s. We have a negative yield curve. Now, before this recession that happened about 1993, we had this negative yield curve, and then we had another one here during the dot-com. Then we had another one here before 2008, and we had a very small one here before COVID, okay? COVID was very short, but it was extreme. Look at where we are at now, okay? Pretty significant, a huge negative yield curve. Now, one thing I want you to see is that before we have a recession, what happens to this yield curve? It starts to move back up, meaning that the 2-year and the 10-year start to go like this, okay? And that's what we're beginning to see happen in the yield curve. And notice here how now we've hit a bottom and we're starting to move back up. What happens when we surpass this par, this zero level, and go past it? What generally happens? We go into a recession. Now, this looks to generally come anywhere between 6 months to a year after we've hit bottom of the curve, most of the times. And what we're seeing here now is this starting to move back up. So what does that tell us is going to be a future event in the US economy? It tells us that we could go into a recession next year. Now, what happens in a recession? What do investors do in a recession? Well, we just talked about it. They go from what? Equities, which are high risk, into what? Into bonds, which are low risk. So all of a sudden you have all these people buying bonds. Well, what happens to the yield when you buy bonds? Well, that's what we're going to talk about. When someone buys a bond and it comes into demand, the yield starts to go down on it, because once it's demand, well, the government doesn't have to pay as much to have someone buy it. So they don't have to pay as much interest on it to have someone buy it. So the yield starts to go down. What happens to the price of the bond? The price of the bond goes up. And that's really good for investors, because what happens is when, let me just go ahead and we'll get this out of here, and we'll just go back to focusing on the yield. Go down to the daily. What happens is say, I buy these bonds really cheap, okay? They're good collateral. And that's another thing about a bond, US Treasury, is it's good collateral. Well, I own this real high quality collateral. Well, guess what? I can sell it. So let's just say the yield starts to roll over and come down, okay? Now, the price of my bond goes up, and say I have, 1 million of these puppies, and Now they're really in demand. People want my bonds. Well, when they buy my bonds, what happens? How do they pay me for those bonds? They pay me in dollars. And dollars are very coveted because they are what? No, they're the reserve currency, and they're the global exchange currency is in dollars. So now I bought these bonds really cheap at high interest rate. I can hold on to those, still getting this 5% interest rate, why they go up in value, and people are starting to bang on my door saying, hey, can you sell us these? You got quite a few of them. Can we get some of them from you? Well, sometimes I might lend them out. Yeah, lend them out. Sometimes I might sell them and get a lot of money. Well, what this is telling us is when the yield starts to go down, these bonds become very, very valuable. It tells us what's going to happen in other markets. So for example, if we're trading equities, well, let's go to the S&P and blow that up. What's going to happen to the S&P? Well, the S&P is going to start to roll over, and it's going to start to go way down. Okay, it's really going to start to go down. What does that mean as a day trader? That means, again, every day I come in, it's not hard for me to figure out the market. I wait for the move up, and then I short that move. It's real easy. It's real easy. Now, yeah, some days you're going to have pullbacks that are going to last the whole day. But you know, the next day when you come in, you're going to be looking for that short, because the pressure of risk off on the market is very, very strong. Okay, it's very strong. Now, that relationship is different right now, but that will change here pretty soon. When we go into 2024, now people will be wanting to buy bonds versus selling them because we have a possible recession. That's risk off. Now they're buying the bonds for security versus rate of return versus equities, which is what it is right now. Okay. Now, with that being said, what's another thing that happens in a risk off move? Now bonds are telling us risk off. Well, what are we going to do here? Well, with dollar, we're going to trade it long. And what's dollar been doing? It's been going long, hasn't it? Because more and more risk comes in, the more we want dollars to secure our situation, the more we want to go into fixed assets. Okay. And so that's really what we're looking at here. So what can we do? We could go long euro dollar, or I'm sorry, short euro dollar, go long the dollar, go short euro dollar, go short pound dollar, go short Aussie dollar, go short Kiwi dollar. We could go long dollar yen. All these nifty things we could do to trade. Every day we come in the markets, we could trade this. It's very easy because we're now blessed with the knowledge, because we understand, one, the bond market and what it's doing. We understand the yield versus the price of bonds, and we understand why demand comes in for bonds. Right now, it's the yield, but in the future, it's going to be what? It's going to be for more security or a risk-off environment. So we can participate based upon that knowledge in the markets. We understand them better. So you need to understand the bond market and how it functions. We've had one of the biggest crashes in the history of markets, and no one's talking about it, and that's the bond market. The prices of bonds have collapsed. So when something like that happens, what do? Well, when price is cheap, you buy. And that's what's happening now. People are beginning to buy these bonds. I know you don't see it in the yield. I know you don't see it in the auctions right now, but it's slowly beginning to take effect. And let me tell you, some of these big investors, the big ones like Warren Buffett and others, are going to begin to start purchasing these bonds because they have the information, they see the writing on the wall, and they're going to start to slowly move into security. You can't move a portfolio like they're hauling around overnight. It has to be done over months, sometimes a year or longer, to move that much without being too noticeable about it. Okay. So another thing that happens, and speaking of the dollar right here, right now, is that liquidity begins to dissipate. Now, what is liquidity? Well, liquidity is done for many different reasons. And this is probably another subject. I'm just going to touch on it lightly here. But what happens when rates go up is liquidity begins to dry up. And liquidity, the main driver of liquidity, not the only driver, but one of the main drivers of liquidity is lending or debt, issuing debt. Now, when you issue debt, you create dollars. And when you create dollars, that would cause the value of the dollar to drop because there's more of it. But when rates are high, you're not issuing debt. And so you have less dollars in the system, which causes the value of the dollar to go up. And so that's another thing we're seeing here, is we're seeing a lack of liquidity in markets. And when you have a lack of liquidity in markets, you begin to have a market go down. And specifically speaking of large cap, something like the S&P, we begin to see it start to roll over because lack of liquidity. Okay. So higher rates at this time are telling you that lending is becoming more and more expensive. Okay. It's becoming more and more expensive. And so because of that, less people are borrowing, meaning less dollars are coming into the system. And that's true around the world because the dollar is becoming very expensive. And to do a loan in dollars, well, to pay that off is becoming more and more expensive. And if you're holding loans in dollars when the dollar was cheap, and you got those loans when the dollar was cheap, as the dollar rises, those loans become more expensive. So it dries up liquidity even more on the global stage, because what happens is you begin to use more dollars to pay that debt off versus, going out and buying more equipment for your business or going on vacations or whatever it is that you spread those dollars, and the velocity of money begins to contract instead of expand. And so we see all these things that are causing, because of the bonds, it's causing a lot of havoc. It's causing a lot of havoc on the balance sheets of banks. And some things are coming up in March of next year, which are going to change a lot of things on the balance sheets of banks. And that's something we're going to keep a real sharp eye on, how the Fed works with the banks to cause things to go in the favor of the banks, because right now it's not looking too good. Okay. So that's one of the things you need to watch out for. So with that being said, I'm going to pause here for just 1 second. Let me pause here and I will be right back. I'm going to fix some technical issues. So give me 1 second here. I'll be right back. Hey, Dee. The train's not on the site. Huh? It's not there. It's not showing. It's showing last week. I did. Okay, it's there. I kept refreshing it, and what's his London show Sean kept coming up.
It's on there, right?
Yeah, I see it.
Okay.
Okay.
That was really.
Yeah. Okay, guys, I'm back. We had a technical issue there. Thought we weren't recording, so I want to make sure that was taken care of. I want to make sure everyone hears this today. So that was pretty important. So I didn't mute myself, so you probably hear me, but that's all right. Let's go ahead and share the screen again, because we're getting pretty close to where we're going to take some questions and where we're going to kind of go over what 7X is about and how it's set up to help people and the different opportunities we have in it. So I kind of want to do that right now with you. And let's go ahead and do that. Let me get over to here and we will go ahead and set those up. Okay, here we go. And I'm going to bring this over here and we're going to go through what we got going on here. Now, I want to talk a little bit about 7X, and I want to talk about the idea behind 7X, because I see a lot of programs out there that are, they're good programs. I'm not going to put any program down. Anyone who's out there legitimately trying to help people, I give them all the credit in the world, because I tell you, this business is tough. Trading is tough. And until you get your habits down, until you get your system down, until you have confidence in yourself, it's a day-by-day effort, strong effort. If you want to do this for a living, and if you want to do this to where you support yourself through it, you're going to have to dedicate some focused time to it. That's all there is to it, because you are going to learn a lot about yourself as you go down this journey. You're going to learn how well you are at changing your habits. You're going to learn how well you are at being dedicated to something. You're going to learn how well you are about following rules, okay? Because if you're going to be successful at this, you're going to have to do all of those things. No question about it. And so our mentors are set up to train you how to do this. We have some good mentors in our organization, and I'm going to go in and talk a little bit about each of their products and what they can offer you here in just a minute. But the overall 7X platform is what I want to talk about. We have developed a platform, and it is in making. It is not completely developed yet. So it is changing. It is improving. It's getting better. But we have developed a platform for growth. And the growth that we've developed the platform for is to help people who really are going to need financial help going forward, meaning they are going to have something that is bringing them in a stream of income. And that's what we're here for, is we're here to help you to learn how to develop a stream of income that's going to support you, whether markets are going up, whether they're going down, whether your portfolio or your 401k is crashing or blowing up. It doesn't matter. We want to help you develop a system of income that's going to support you through difficult times, because difficult times are on their way and the financial markets are changing dramatically. And you have to have someone by your side helping you through that process as financial markets change, so they can see what's on the near horizon and protect you. That's what we do here at 7X Investors. We have developed a community. And that's one of the most important things I can stress here, is a community. Why is a community important? A community is important because you're going to need help. As you enter into this business, you're going to need help on how to fix things, how to fix yourself, how to fix and understand how to fix your trading, what to look for, how to understand when to stop trading and when to trade. A lot of people overtrade. A lot of people go against the trends. We call that catching a falling knife, by the way. There's a lot of things you're going to have to develop as you go in and do this, okay? So let me explain how this is laid out to help you do that, okay? We have the free section. Now, what the free section is designed to do, and that's where anyone can come in, open up a free account, join the community, the 7X investors community, and if they have any questions, or they want to share their experiences, their wins, or they, they don't understand something, they can always put their questions in the chat. And I or some other member will come in and help them answer that question. Okay. And that's the important part of the community. Plus, we give some free training like we did tonight to help you understand the markets better. So that's what the free community is designed to do, help you understand trading as a whole. And then once you begin to understand it, you can begin to select where you want to put your efforts into. And we offer efforts put your efforts into 3 areas. The first one of those areas is the product which I do, and that's called Alpha Trader. Okay. So this is Alpha Trader. And what we do here is we trade Forex and currencies. Now, trading Forex and currencies is a little different because they're not an exchange. They're not governed by rules. They're what's called over the counter, or they're generally done by banks and regular exchanging between goods and services across the globe. And so they're a little bit different animal than an exchange. And so in Alpha Trader, we teach you how to trade the Forex markets. And Kordell Stevens, and Ty serve as your mentors in here. So we teach you how to trade these markets. We teach you how to day trade them, and we teach you how to trade them long term. And so you can begin to get an understanding how these markets work. We also offer you an indicator that really helps you see the markets a lot better while you're learning them. So you can actually trade them while you're learning how to trade the market, while you're learning all the stuff that's going on behind. So now you eventually come in, once you learn that, and trade the markets with knowledge. But before you learn that, you're going to want to trade the markets. So we have built an indicator to help you understand how to trade that market, and giving you more wins and losses so that you can go in. If you want to trade, once you develop your habits, you want to trade live money, or you want to trade a prop account, you can do that. So that's the great thing about entering in Alpha Trader if you want to trade Forex and CFDs, contracts for differences. And so we meet with you 4 nights a week. We trade with you the Asian session. I also meet with you twice a week. And one of those nights is a mind for trading. That's where I teach you how to develop the habits that you're going to need to trade the markets. And another one is just to teach you how to take a replay, go through it, and develop the habits you need as you see the trades beginning to appear on your screen, how to manage those trades, how to develop your risk. We have a risk calculator that tells you how many pips you can risk when you go into a trade based upon what your risk parameters are for that day. And you can do that in a few seconds. So you know exactly how much you can put on that trade, where your stop's going to be. And that's one of the most important things, is the stop, because that tells you your risk. That tells you how much you can risk on that trade. So very important. Okay. So that's some of the things we do in Alpha Trader. So a really great value on that. That's $249 a month for that. Next, we have Dan Kelly in 7X futures. Now, if you want to trade on an exchange and you want to trade future contracts, this is where you want to go. Dan has developed a system that allows him to be a very profitable trader day after day and he can teach you how to trade futures by mentoring you. He meets with you every single morning, Monday through Friday, to trade the markets. So you can see him live trade the markets. And then he meets with you twice a week at night to give you education on how to trade the markets. So you have that mentorship there to show you how to trade futures. And it's a great opportunity for those who want to go into trading future contracts. Now, future contracts move very fast. So in the beginning, you're going to want to trade small amounts with him, not large amounts. Plus, he has a plan to show you how to accumulate PA accounts so that you can go ahead and trade very low risk and make a substantial amount of money every day by doing that. So if you want to get into trading futures, Dan, in my opinion, is one of the best future traders I've seen, and he can take you in there and teach you how to trade futures. Next, we have London Breakout. So here's London Breakout. And this is done by Sean. He calls himself London Show Sean. And what this is designed to do is it's a signal service. This is for people, and it mostly deals with Forex. This is for people who do not have the time right now in their lives to trade on a regular basis, either the Asian session or the US session, or anything like that. If you're from the US, if you're trading the London session, you got time to do that. That's great, because that's when London Show Sean trades, is the London session. However, he only has one trade he does, and that trade is posted each and every night, 5 days a week, or 4 days a week, 5 days a week, yes. And what that is he will post a trade, and that trade will either be profitable or you'll get stopped out. However, the stop is designed not to give you a huge loss where you can't recover from it. So that's the most important thing about your stops. They need to be designed in a way where when you get stopped out, because you will always have a stop loss, you will always have a stop. You'll always get stopped out of trades. There's no way around that. When you're stopped out, though, you want to be stopped out at a small amount, and then you want your gains to overcome your stops. And so that's one of the things they do in London Show with London Show Sean. When he makes those posts, they make sure that your stops aren't too large. Now, we do that in all of our programs. We teach you about the stop and about the risk. But here, you get up, you put in the trade, you just put it on there, and then you go back to bed, get your sleep, wake up the next morning, and sometime either in the morning or during that day, that trade will pop out as a loss or pop out as a win. And that's pretty much it. It's a real basic way where you can start getting used to trading. You can start building an account, and you can begin to prepare to go on to trade either with Dan Kelly in futures or with me and Ty in Alpha Trader, Forex, and CFDs. So that is pretty much the rundown on our products that we offer right now. In the future, we're going to offer even more products. The next thing I want to get into is our partner program. Now, a lot of people, maybe they don't want to trade, okay? Maybe they just would like to have a way to get money without trading, and that's what the partner program is about. So if you don't trade, or if you do trade and you want to earn some extra money, this is what we call an affiliate program. And this is our affiliate program. We're still in development of it, but you can join it and get your affiliate links. So you can refer people and get 35% of the monthly charge. Now, I forgot to mention the charges on the other two products. For futures, 7X futures, it's $249 a month. And for London Breakout, it's $89 a month. So you can go in and you can promote those products. And each month that someone you brought in purchases or does their monthly fee, you get 35% of that. It is very generous in the industry. And the reason why we made it so generous is because we want people to have a way to make money that they can trade if that's something they can do. And as time goes on, we're going to develop advertising methods in here that you can latch onto and really grow your membership in the 7X platform and get those monthly payments coming into you. For a $249 a month product, you're going to be making a little over $85 a month. And so if you got 10 people on that, it's $850 a month you'd be making. So these are just some of the ways that we've designed 7X to be able to help people who may not have the bank account to trade with right now. They can kind of go this route and build that account so they have something to trade with, so they're not using their important money that they use to pay bills with. They can do it this method. And as time goes on, we're going to make it more and more simplistic for you to do this, kind of like a plug and play type system. And also for those who don't want to trade, but would like to make some money just promoting 7X. And so those are the two types of people this is appealing to, the 7X partner program. So that's something you can also do. And it helps us on advertising costs. I mean, the more people are advertising for us, the less we have to pay in advertising costs, the more we can go to develop more money that can go to developing the platform and bringing in new items that help people earn and build investment capital so they can have an income stream. So it helps us out as well. There's some other things that will be growing, coming into play and growing over time. That's Rise and Evolve. That's where we help you develop the entrepreneur mind mentorship program. So you develop a mind of an entrepreneur, because a lot of us have worked for people all of our lives. We're not really sure how to be an entrepreneur. And in that program, we're going to help you how to design the habits and the processes to become an entrepreneur, because you're starting essentially your own business when you're going to trade in the markets. So those are just some of the things that we offer here in 7X and in our programs. So pretty awesome. We spent a lot of time. It took us pretty much a year or more to build this program. And so pretty extensive. So that's something that we take pride in, and we like what's happened there and what's going to happen in the future. All right, that pretty much wraps up things. I don't see any questions in the comment section, so we're going to wrap this up tonight. I want to thank all those who were on, and those who are going to view this in the future. I hope this helps you. Hope it helps you understand more about how to use bonds to trade markets. Also, if this is a platform you're interested in, go ahead and go to www.7xinvestors.com, sign up there for a free account, and come on in, join us, look around, ask us questions, kick the tires, and let's see what we can do for you. This concludes the free training for tonight, and I wish you all the best of luck as you pursue your trading career. Take care now, and we will talk to you later.